Welcome to Accounting with Our Bare Hands, a series of short videos on the mechanics of cost accounting. Today is the second in a series of 5 videos on standard costing, direct material variances. So let's jump right into an example with some debits and credits. We're going to assume that we have 2 people in our firm that will matter for this example. We have a purchasing manager who buys some raw material. Okay? So 500 kilograms at $2 per kilogram, so spends $1,000, but the standard price here was instead $2.50 a kilogram. Okay, so the purchasing manager has gotten a nice deal here, being able to buy at $2 instead of $2.50. And then we have our production manager who's in charge of using the raw material to create some sort of good. And he actually used 10 kilograms of the material, but the standard amount that was supposed to be used was 8. Okay, so 8 kilograms. So what do we have, just looking at the basic facts before we jump into the debits and credits? We had a purchasing manager who got a good deal on some raw materials and a production manager who ended up using them a little less efficiently than he should have. Now, if the goal of our accounting system is to isolate responsibility for deviations from the budget, deviations from performance standards in the budget, it turns out that it's going to be very useful to record these inputs, the price and the quantity of raw materials used, not at the actual cost, but at the standard cost, what it should have been according to the performance standards in the budget. So let's take a look at this in our Queen's Cross. Here's our Queen's Cross. I put our assumptions here in the liabilities portion because we won't be talking about liabilities. We'll assume that the purchasing manager purchased the goods with the raw material with cash. So now how much cash was actually used up? The amount that was used up was actually $1,000, 500 kilograms at $2 a kilogram. So in order for our accounts to match the bank's records, we'd better make the credit for the actual amount that we spent. But we are not going to put $1,000 into the raw materials account. Instead, we're going to put into our raw materials account what it should have cost to buy 500 kilograms according to the budget. So what should it have cost? 500 kilograms at $2.50 is $1,250. And so we're going to debit our raw materials to reflect an asset equal to what the materials should have cost according to our budget. Now, we have too many dollars on the debit side compared to the credit side. We're going to need more credits. Where are we going to put that? We're going to put that on the income statement in what is called a direct materials purchase price variance. Okay, we need $250 more of a credit. Now, remember that here, and this is a little odd, here we have our expenses and losses in the lower left side. Well, what does it mean to have a credit, expense, or loss? So that's an unnatural balance. Normally, credits on the income statement are revenues or gains. you can think of this as a reduction in expense and loss, because ultimately, as we'll see as we go through these standard costing videos, we're going to have a big expense, which is cost of goods sold. This is going to reduce cost of goods sold. It will be an adjustment reducing cost of goods sold for $250. So by making this entry, what are we saying? We're saying basically that the purchasing manager has earned our firm $250 through his wisdom in finding out how to buy goods for $2 a kilogram when they should have cost $2.50 according to the performance standards in our budget. So we're going to recognize that as income right away and boost our assets as a result. Okay, so that's the first event in our little story, that the purchasing manager saved us some money. Now let's consider the second part of our story. The production manager used some of these raw materials and unfortunately used 10 kilograms for a job that should have taken only 8. Well, we're going to have to take the raw materials out of this account according to how much was actually used. So what did we put in? We put in $2.50 for every kilogram. So we're going to take out $2.50 for every kilogram that was actually used. Since that was 10 kilograms, we're going to credit this account for $25. But that is not the amount that we are going to put into our work in process department, work in process account in the production department. Instead, we're only going to put into inventory the cost that we should have incurred in direct materials. So we should have used only 8 kilograms. 8 kilograms at $2.50 is $20. So here you can see we've actually lost $5. We transformed a $25 asset, or $25 of asset into only 20. Where does the 5 go? You're probably guessing this by now. That's going to go on the income statement as an expense. It's going to be the direct materials usage variance. And we're going to need a debit of $5. Okay, so now, of all that $250 we saved, now that we start using our materials inefficiently, now we've undone $5 of that benefit because we have an expense. So notice that when, just as when we did something better than our performance standards said we should, we recognize some income. Now we do something worse. We recognize a loss. We're not given the opportunity to boost our work in process and show that cost overrun as an asset that is something with probable future economic benefit to the firm. Instead, we're saying, nope, that's a reduction in wealth. Okay, so again, both of these items are going to be adjustments to cost of goods sold. Will reduce cost of goods sold by $250 for the purchase price variance, but will increase it by 5 for the usage variance. Okay. One last comment before, or actually 2 last comments before we end this video. First, it's useful to distinguish 3 concepts that in ordinary conversation are often blurred together: blame, responsibility, and accountability. So blame is a causal attribution. We are saying that someone's action created, say, a cost underrun or a cost overrun. Do we want to give the purchase price manager the credit, which is the good side of blame? Do we want to give the purchase manager the credit for saving $250? Do we want to say that it's the fault of the production manager for using 10 kilograms instead of 8? Well, that causal attribution might not make any sense. Suppose that we're just buying wood Hey, that's what the purchase manager is doing. He's going out and he's buying wood. Well, it could be that just because of economic conditions, wood, which is largely a commodity, fluctuates in price, and so it's no fault or credit of the purchase manager that he saved $250, right? Because it was just something that the economy did. So just because we've identified this $250 and basically put the purchasing manager's name on it doesn't mean it's the purchasing manager who deserves the credit. Similarly, the production manager doesn't necessarily deserve the blame. I mean, maybe the way the maybe the purchasing manager saved money by buying lousy wood with lots of knots in it and other imperfections. And so the reason it took more wood than it otherwise would have is because the production manager had to work around the flaws in the material. So it's really the fault of the purchase price manager, even though it shows up in an account that we would say is owned by the production manager. That's why accountants don't use terms like blame a whole lot. Instead, accountants talk about responsibility and accountability. Responsibility is a set of 3 duties. A manager is responsible for an account if they have the duty to know the status of that account at all times, to be able to explain the status of that account, and to be able to propose fixes, propose responses to what they know. So, for example, here, right, the purchasing manager may or may not be deserving of credit for this $250 lower cost of wood purchased, but certainly the purchasing manager has a duty to know that the cost of the raw material has been coming in lower than expected, has the duty to know why that's happening, and has a duty to propose what should be done. Similarly, the production manager has the duty to know that materials are being used at a higher rate than the standards say, has a duty to know why that is, and you know what, maybe that's because the purchasing manager got lousy wood, in which case the recommendation the production manager might make is, hey, let's get better wood so that we don't use it so inefficiently. Right? So that's the distinction between blame and responsibility. Again, blame is a causal attribution. Responsibility is the duty to know, explain, and propose a response. Finally, we have accountability. Someone is being held accountable for a report, a number on a report, if we are going to use that number to evaluate their performance, to pay, to determine how much to pay them, whether to promote them, and so on. So these are all quite different, right? We might hold the production manager responsible for this $5 overrun, which means they have the duty to know about it, explain it, and propose responses, but we might not blame them for it, and you know what? We might or might not hold them accountable for it. Maybe we want to say, yeah, we know it's not always your fault. It might be the responsibility of someone else. It might be the responsibility of the economy. It might be the responsibility of just inexplicable variations in the production process, but we still might make your bonus depend on this number, or we might not. So blame, responsibility, and accountability are all distinct. The last point I want to make is going back to this rather odd idea that we are going to record costs at what it should cost, according to the performance standards, rather than at what it actually costs. We are gaining here by highlighting information about deviations from the budget. If what we care about is efficiency, if our goal is to do what we do more cheaply and at higher quality, then this is a wonderful way to set up an accounting system. But no system is perfect, and it's important to recognize that we are losing some information. We are going to pile up these variances, adding them, we'll keep debiting and crediting these accounts for all of the items that we make. And we will have a sense overall of whether the purchasing manager and the production manager are, whether their processes are going well and are coming in over or under budget. What we're losing, however, is we are losing the ability to isolate the margins on individual products, because you'll notice this product actually cost $25 to make. We only recorded it at 20. So we've lost the ability to get an accurate reading of the margin, true margin, on this product, and we were willing to give that up because we cared more about getting good information on efficiency. I hope you found this video discussion helpful, and I hope you'll come back and watch the remaining videos on standard costing. Bye-bye.